Welcome to This Explainer. Look, if you've been keeping even half an eye on the markets lately, you already know. It's been a completely wild ride. Today, we're diving straight into all this recent macroeconomic volatility, but more importantly, we're going to talk about how reliable dividend stocks can act as your ultimate financial safe harbor. Because let's face it, when the headlines get chaotic, your portfolio absolutely does not need to panic. Here is how we're breaking things down today. First, the volatile economy. Second, enter dividend anchors. Third, Exxon Mobil, the energy hedge. Fourth, Verizon, high-yield connection. And finally, number 5, Coca-Cola, the everyday staple. Let's get right into it. Section 1, the volatile economy. Just look at the sheer speed of these market reactions. It is practically whiplash. Our data tracks market sentiment starting right from day one of the Trump victory, which was heavily touted as this new golden age. But then, boom, barely a month later, enforced tariffs triggered a massive shock. We're talking about the S&P 500 plunging nearly 20% in just 1 month. But wait, it gets crazier. Those tariffs were eventually walked back, and the S&P actually closed out the year up 18%. Fast forward to year to date, and things like the conflict with Iran and the Strait of Hormuz blockade threw a massive wrench right back into the global gears. Now, I really want you to focus on this number right here, 50%. When we zoom in on the energy sector, oil went absolutely parabolic right after that Strait of Hormuz blockade. It surged by more than 50% year to date. I mean, that kind of sudden massive spike, that's exactly the type of shock that genuinely threatens to trigger broader market crashes. And this quote from our source really just hits the nail on the head regarding the panic at that exact moment. There was plenty of chatter about $200 for a barrel of oil. Just take a second to really think about what that would mean for us. We're talking everyday transportation, manufacturing, global supply chains, all taking a massive hit. Now, sure, tensions seem to have cooled off for the time being, but that memory, that panic, it lingers. It's a really stark reminder that geopolitical uncertainty can flare right back up in the blink of an eye. Which brings us to Section 2, enter dividend anchors. So what's the solution here? Well, the crucial takeaway is that reliable dividend payers consistently hand out income to their investors, even right through recessions and tough economic hardships. They're essentially giving you a steady, predictable flow of cash, completely regardless of what the broader market is doing. In a way, they act as this massive, heavy anchor keeping you grounded when the economic seas get incredibly rough. But of course, there's always a catch, right? Choosing the right dividend stocks means you've got to navigate a classic trade-off. On one hand, you have companies like Verizon offering a really high immediate yield, but typically they come with much slower overall company growth. Then on the other hand, you've got companies like Broadcom. They might offer a lower initial yield, but they bring tremendous long-term growth prospects to the table. So it really boils down to your personal strategy. Do you need that income right now, or are you playing the long game for growth? Let's look at some examples in Section 3. Exxon Mobil, the energy hedge. Right off the bat, Exxon Mobil is offering a very solid 2.71% yield. Now sure, the stock did pull back a little bit from its all-time highs after that initial blockade rally cooled off, but honestly, it remains an incredibly attractive option if you're an income-focused investor. It gives you stability. Essentially, it pays you a premium just to wait things out, just in case that uncertainty in the Strait of Hormuz, or really anywhere else in the global energy supply chain, decides to rear its ugly head again. And you've got to appreciate the historical resilience here. We aren't talking about some flash-in-the-pan tech startup. Both Exxon and Mobil trace their roots all the way back to Standard Oil, which was founded in 1870. Fast forward through a historic merger in 1999, and today they are literally the largest gas company in the U.S. Think about everything they've lived through. Over a century of economic storms, world wars, recessions, you name it, they've weathered it. Because of that immense history, Exxon Mobil holds the prestigious title of a true dividend aristocrat. And what does that actually mean? Well, it means they haven't just paid a dividend. They have actively raised their payout for 43 consecutive years. I mean, wow. Through 4 whole decades of unpredictable markets, dot-com bubbles, housing crises, their payout to shareholders just kept going up. That is the very definition of reliable. Moving on to Section 4, Verizon, high-yield connection. Okay, this number is just huge, 6%. That is incredibly hard for any income investor to ignore. A 6% yield provides some serious, immediate cash flow to your portfolio. Now, remember that trade-off we talked about earlier? Usually when you see a yield this high, you shouldn't expect explosive company growth to go along with it. You're mainly buying into it for that massive, steady income generation. But here's where it gets really interesting. Surprisingly, despite being known as a slow growth, low volatility stock, Verizon shares have actually rallied 15% year to date. Our source points out that this kind of abnormal, but hey, highly welcome performance is largely thanks to the company's exposure to AI and the continuous rollout of 5G networks. So you're not just getting that massive 6% yield, you're also seeing some really healthy capital appreciation alongside it. The underlying logic for why Verizon is considered so safe is simple, but man, is it powerful. It really comes down to consumer wireless services. Just think about your own monthly budget for a second. When the economy dips and money gets a little tight, yeah, you might skip a vacation or maybe stop ordering takeout. But are you really going to cancel your cell phone plan? Probably not, right? It's one of those expenses that just blends right into the background of modern life. And because of that, it practically prints billions of dollars for Verizon every single quarter, rain or shine. And that brings us to our final case study, Section 5, Coca-Cola, the everyday staple. Sitting at a 2.82% yield, Coca-Cola offers an incredibly dependable income stream. And what exactly is that income built on? Well, it's built on a massive range of beverages that millions, if not billions, of people around the globe drink every single day. I mean, it is the textbook definition of a defensive stock. People are going to buy a Coke whether the market is up or down. The sheer scale of Coca-Cola's economic moat is honestly kind of staggering. First off, it's got the ultimate stamp of approval. It has been an absolute cornerstone in Warren Buffett's portfolio for almost 40 years. Second, we aren't just talking about that one classic red soda can here. They own more than 30 different brands. And get this, each of those is worth over $1 billion. Finally, as they keep expanding into key global markets, they are projecting a steady 2% year-over-year revenue growth all the way through 2025. It's basically an economic fortress. So as we wrap up this explainer, I really want you to ask yourself, how is your portfolio anchored against the next unpredictable headline? We've just seen exactly how fast tariffs, global conflicts, and crazy oil spikes can totally rock the market. Companies like Exxon Mobil, Verizon, and Coca-Cola, they offer a proven, battle-tested framework for weathering those exact storms. But here's the big question. As global tensions keep evolving and new tech continues to disrupt traditional industries, are these classic anchors going to hold strong for another 40 years? Or is it time for us to completely redefine what a safe harbor truly means in our modern economy? Definitely something to think about. Thanks for joining me for this explainer, and I'll catch you next time.